Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hexcel Corporation Annual Report. Hexcel Corporation offers a diverse range of products and services across various industries. The company's composite materials segment provides carbon fibers, fabrics, multi-axials, specialty reinforcements, prepregs, structural adhesives, honeycomb, molding compounds, tooling materials, polyurethane systems, and laminates for use in commercial aerospace, space and defense, industrial applications, automotive, marine, rail transportation, wind turbine blades, recreational products, and military aircraft. The engineered products segment of Hexcel Corporation manufactures and markets a variety of aircraft structures and components, including wing-to-body fairings, wing panels, flight deck panels, door liners, rotorcraft blades, spars, tip caps, structural subcomponents, semi-finished components, RF interference control products, dielectric absorber foams, magnetic absorbers, and thermoplastics for commercial and defense applications. The company also offers services related to its products, including interference control materials, structural composites, and technical support. Hexcel Corporation's products are sold directly through its sales personnel and managers, as well as through independent distributors in various regions around the world, including the Americas, Europe, Asia-Pacific, India, and Africa. With a rich history dating back to 1946, Hexcel Corporation has established itself as a leading provider of advanced materials and engineered products for a wide range of industries. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what could cause Hexcel Corp's stock price to increase in the past year. Hexcel Corp is a leading manufacturer of composite materials and technologies for commercial aerospace, space, and industrial applications. The company's stock price has increased significantly over the past year due to several factors. One major reason for the surge in Hexcel Corp's stock price is the growing demand for its products in the commercial aerospace industry. As airlines continue to order new aircraft, they require more composite materials from suppliers like Hexcel Corp. This increased demand has led to higher sales and revenue for the company, resulting in a rise in its stock price. Another factor contributing to Hexcel Corp's success is its expansion into new markets, such as space exploration and renewable energy. The company's advanced composites are being used in various applications, including satellite components and wind turbine blades. This diversification has helped reduce the company's dependence on any one market and increased its overall revenue. Additionally, Hexcel Corp's focus on innovation and research and development, R&D, has enabled it to stay ahead of the competition. The company invests heavily in R&D, which has led to the creation of new products and technologies that meet the evolving needs of its customers. Lastly, the company's strong financial performance, including a significant increase in earnings per share, has also contributed to the rise in its stock price. Hexcel Corp's ability to manage costs effectively and maintain a healthy balance sheet has given investors confidence in the company's future prospects. Overall, the combination of growing demand for its products, expansion into new markets, innovation, and strong financial performance have all contributed to the increase in Hexcel Corp's stock price over the past year. Hexcel Corporation maintains a market capitalization of $7 billion, broadly in line with the industry peer group. Hexcel Corporation trades at a higher price-to-earnings ratio of 64 times, and a higher price-to-book ratio of 5.32 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 44% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors across different segments, regions, and customers. On the growth side, commercial aerospace, defense and space, industrial applications, automotive industry, recreational products, and increasing global emphasis on emissions reduction are key contributors. Additionally, government contracts, export control laws and regulations, expansion into new geographic locations, diversification of product offerings, and increase in production capacity at existing facilities also drive revenue growth. On the decline side, cyclical downturns in markets, supply chain challenges, labor disruptions, regulatory issues, reductions in demand for commercial aircraft, delays in deliveries, changes in customer purchasing habits, loss of significant customers, and significant changes in design or materials used to construct commercial aircraft are primary drivers. Furthermore, reductions in defense and space spending, decline in production of military aircraft, unmanned aerial vehicles, and missiles, and decrease in demand for composite-intensive programs also contribute to revenue decline. The growth and decline drivers vary across different segments, regions, and customers. For instance, the United States is expected to experience significant revenue growth, while France and Germany are expected to decline. Airbus and its subcontractors remain a significant customer base, accounting for 39% of net sales in 2025, followed by Boeing and its subcontractors at 13%. Net income for a company decreased significantly between 2024 and 2025. In 2024, net income reached $132,100,000, but by 2025 it had dropped to $109,400,000. This decline was largely due to lower sales in certain Airbus and Boeing programs, which were partially offset by increased other commercial aerospace sales. The decrease in net income also resulted from supply chain challenges, labor disruptions, and regulatory issues that affected the company's operations. These factors contributed to a decline in profit margins, which fell from 9.8% in 2024 to 9.1% in 2025. The gross margin percentage also decreased during this period, dropping from 24.7% in 2024 to 23% in 2025. The reasons behind the change in net income and profit margins were multifaceted. In addition to supply chain challenges and labor disruptions, the company faced delays in aircraft production rates, global logistics issues, and economic conditions that included inflationary pressures and tariff impacts. Geopolitical issues also had a negative effect on the company's operations. The company's financial performance indicates a strong ability to generate operating cash flow. The data shows that the company has consistently produced positive operating cash flow over the past 3 years, with a notable figure of $230.5 million in 1 year. Furthermore, free cash flows have also been positive for both 2024 and 2025, with a significant amount of $157.2 million calculated for 2025. This trend suggests that the company is generating sufficient operating cash flow to support its operations, indicating a healthy financial position. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt increased from $700.7 million to $993 million between 2023 and 2024, indicating a substantial rise in debt levels. This increase is also reflected in the long-term debt, which has grown significantly from $700.6 million to $993 million during the same period. Furthermore, interest expenses have also seen a notable increase. The net interest expense rose by 10.9% from $34 million in 2023 to $37.7 million in 2025, indicating a significant jump in interest payments. This increase is attributed to interest differentials resulting from interest rate agreements. However, it's worth noting that there appears to be conflicting information regarding the change in debt level and interest expenses across different pages of the summaries. The company's performance varied across different segments and regions. On the positive side, the composite materials segment stood out for its ability to serve various international markets. The commercial aerospace, defense and space, and industrial applications sectors also performed well, indicating a strong presence in these areas. However, some regions struggled to keep pace with the company's overall growth. Europe was one of the underperforming regions, exposed to foreign currency exchange risks that negatively impacted its performance. Furthermore, the divestment of Austria operations in this region highlighted the extent of its underperformance. Management is prioritizing make-to-order production to avoid excess inventories and shortages of key raw materials. This strategy aims to improve product performance and reduce costs through investments in R&D. The company is also focusing on specific sub-markets and specialty products where it can differentiate itself from competitors. However, management acknowledges that there are significant barriers to entry in the market, including intellectual property, unique skills, and expertise. To overcome these challenges, the company is investing in training and professional development to encourage employees to aspire to different career opportunities. Despite these efforts, management expresses uncertainty about achieving goals and projections due to various factors such as regulatory activity related to the Boeing 737 MAX, raw material cost and availability, and cybersecurity measures. The company also expects to face challenges from a global macroeconomic environment that poses significant risks to its business and financial position. To mitigate these risks, management is focusing on core competencies through business restructuring, divestitures, and acquisitions. Additionally, the company is expecting cash flow needs for fiscal year 2026 to be funded by cash generated from operations, as well as available borrowings under the senior unsecured revolving credit facility. Overall, management's outlook is cautious, with a focus on adapting to changing market conditions and mitigating risks through strategic investments and restructuring efforts. The company's financial activities have been multifaceted. One notable aspect is its dividend payment history. As per the provided information, the company has paid dividends on multiple occasions, with specific references to pages 51 and 66 in the supporting documentation. In addition to paying dividends, the company has also engaged in share buybacks. This strategy allows the company to repurchase its own shares from the market, potentially increasing shareholder value. The company's share buyback activities are documented across various pages, including 20, 51, and 66. Supply chain disruptions pose significant concerns for commercial aerospace industry. The commercial aerospace industry is facing significant challenges due to supply chain disruptions. Delays in planned production and negatively impacted aircraft build rates are just a few of the consequences of these disruptions. Various factors such as tariffs, sanctions, currency exchange rate fluctuations, natural disasters, severe weather events, cyberattacks, and third-party supplier risks have all contributed to this issue. The impact of supply chain disruption is evident in the industry's production rates, with delays reported on multiple occasions. Furthermore, inventory reduction actions taken by companies have led to lower gross margins, suggesting that supply chain disruptions are having a direct financial impact on businesses. Overall, it appears that supply chain disruptions pose significant concerns for the commercial aerospace industry, and addressing these issues will be crucial for its future success. That concludes the financial summary for Hexcel Corporation. Feel free to comment below, and I will be happy to answer them when possible.